Excellent. Thank you, Peter. For those of you that might not know me, I'm John Benko. I'm the current president of ADL Delivery and past president of the CLDA, and really happy to have you guys here this morning. This is hopefully going to be a very interactive panel, and so we want your input and any questions that you might have. So feel free to raise your hand during the discussion or after the discussion, where we've got some time set aside to hopefully talk through that so that you guys get some value out of this. So with that, guys, we're going to dive right in. And Alex, we'll start with you. If you could tell the audience, a lot of folks in the room have probably already been approached by multiple investment firms, whether it's a PE or an angel investor. What are the different types in your mind of potential buyers that somebody could be approached by? Kind of walk us through what that looks like, if you would.
Sure. I like to segment buyer types into three major types of buyers. The first set of buyers I would kind of call strategic buyers. These are buyers that are not backed by a specific type of financial sponsor, whether that be a private equity firm or a venture capitalist fund. These buyers could be publicly traded companies. These buyers could be privately held companies that are entrepreneur-led, family-owned, but they typically don't have a private equity or VC fund behind them that has kind of an exit timeline or an exit horizon for selling that business, in 4, 5, 6, 10 years, right? In terms of the other two buyer types, I would classify them as private equity or venture capital. These are funds that have committed capital, and they are typically 10-year funds. Their mandate is to acquire businesses, platform businesses, if they're investing directly into that opportunity, and scale, grow those businesses to get and then exit that business, depending on their, goals that have been met. Almost all of these funds have to buy and sell their businesses within 10 years. Sometimes there's some extensions around that, but typically that is the model of a private equity or venture capital firm. And even within that, private equity typically invests behind businesses that are profitable or have earnings. Private equity typically uses leverage to buy businesses, whereas venture capital is primarily equity-based, and that could include all flavors from angel investors, B, C rounds, and they typically have longer time horizons, but are investing in companies that have the opportunity to turn profitable, but typically are not profitable yet. And then there's kind of a third class, which is a little bit a hybrid of the two. It's private equity or venture-backed strategics. So American Expediting would be considered one of those, where they're a buyer, but they are a strategic, but they're backed by a private equity firm. So they're going out and making add-on acquisitions to build onto their platform as part of their growth strategy. And really, what buyer type you choose really depends on what your goals are as a business owner. And I'm sure others here have that experience with the certain buyer types and can speak more to that. But, determining what your goals are. Do you want to stay in the business, continue to grow it, sell, exit stage left? There's different buyer types for different types of goals.
Absolutely. Thanks, Alex. Great info. So, Sean, from your perspective, it sounds like you would fit in the strategic category. So I know that you've done some acquisitions over the years, and it's more of an A and B relationship rather than having somebody from the outside help you go through that process. Can you share with the audience a little bit about that?
Sure. So we're privately held. We are VC backed. So we raised capital. We did a seed round. We did a Series A. We did a Series B. So we have investors that have, a 5 to 10 year time horizon that they're looking to get a return on their investment. Part of our strategy from day one has always been organic growth and inorganic growth. So growth through sales and marketing, and then growth through acquisitions. We've done 8 acquisitions to date. We did our 8th this year. So we're basically running one a year, essentially. And, we're not mandated to buy anybody. We're looking for really good businesses that are well-run, that have good customers. We do a lot of healthcare, so that's an important part of sort of the mix for us. And at the end of the day, if we don't find that business that fits our criteria, we're not going to buy anybody. And so in 2021, we didn't buy anybody because we just didn't find anybody that was a great fit. And so for us, we don't plan the business around acquisitions, but it's a big part of our strategy, and we have a team dedicated to executing against that. And what we're buying is folks like you out in this audience. We're buying, owner-operated businesses that have been doing it for 10, 20, 30 years, know what they're doing, know the industry, have good relationships, have good customers, have a good team, and run a business, know how to run a business well. That's what we're looking for.
Excellent. Thank you, Sean. So, Chuck, from a process standpoint, if I'm somebody in the audience and I'm thinking about exiting my business, what should I prepare myself to do before I reach out, or when I'm approached? How do I go about considering the process that I'm going to go through? Could you walk us through what you've experienced with some of the companies that have gone through that process?
Sure, I'll be glad to. First of all, let me back up on that last question, because a lot of times we focus on the sales side, right? Well, I'm going to add one more group to the list that was already given, which is absolutely accurate. But often, and people in this room don't necessarily think about it, but is an extension to what I'll get to with John's question, is you are potential buyers out there. If you set a certain goal that you want for your company, you may not be there just yet. Peter mentioned it before, that 2 to 5 year time frame to prepare for exit. Well, to get the multiple that you want, you may need to be more strategic. You may want to go out and buy some other company or competitor to get that strategic component to drive your multiples up, to get your EBITDA numbers up. So as we talk through this, consider not only the discussion around selling your company, but should you be considering as a strategic part of your growth, buying a company? So John, your question, I've done due diligence on a lot of companies. We've had panels before. A lot of CLDA members have called me and they typically say, Chuck, I'm not ready yet, but what do I need to be thinking about? What do I need to prepare for? More often than not, at the end of the phone conversation or face-to-face conversation, they say, well, I need to go back and work on my business several years because I'm not ready. Their management team may not be what it needs to be for the appropriate buyer. They may not have the data room or track certain data that a buyer is going to want, including risk management from any pending lawsuits, claims, loss ratios, all of that stuff they're going to be asking you for. So most due diligence lists, and you guys have your list and your experience, but the ones that I've used probably has about 200 line items that we will talk to companies about and want that information. So position your company now, start building a data room, start tracking that data, run your company today as if you're preparing for selling, because it's just going to position you better and improve your profits today. So
Chuck, for simple guys like me, what's a data room and what's it used for?
Okay, data room is just that. It's electronic. Save all your information. If you are thinking about exit in the next X number of years, talk to someone, get that list, start keeping that information stored. Because if somebody walks up to you and says, what's your 3-year loss ratio? What legal claims have you had against you? Which ones are closed? Which ones are pending, et cetera, et cetera. There's a lot of data that they're going to want. And if you don't have it ready, then the closing process and the evaluation process can take many, many months. So go ahead and prepare yourself for that. It just lets you run your business more efficiently and effectively anyway.
Yeah, that's a great segue into what Peter's going to share with us. So Peter, due diligence, walk the audience through at a more granular level what Chuck was outlining. So when you get ready to acquire somebody, what is it that you're looking for? What are you going to ask for that's going to be in that data room? Give us an idea of what they're in for if they raise their hand.
Yeah, if I had to kind of chunk out, if you will, what any acquirer is going to want, it's number one, financials, right? Margin, diversity of earnings, customer list, and those things can be confidential and protected. I know we'll talk about that a little bit as well. Certainly contractor or driver list, asset list, key employees, insurance documents, claims documents, lists of liabilities, lawsuits. Really, to Chuck's point, you have to publicize to key people on your team. I know there's a big concern that, gosh, I don't want to tell my people that this company's going to be for sale, because if that word gets out, it gets to my customers, it gets to my drivers, everybody's going to leave. But if you have a trusted group of advisors within your organization, and you run your business like it's always for sale, and you practice those fire drills that, hey, we're going to pull these 5 things, these 10 sets of data, then it's always ready. And it's not a big surprise when a list of 170 items, shows up. But contracts, other key documents are going to be important to that conversation.
Absolutely. Thanks for sharing, Peter.
Can I jump in here?
Absolutely.
So financials are critical, and they need to be in good order, right? A lot of folks use QuickBooks, which is fine. You can do easy outputs from QuickBooks. But whatever you're using, you want to have them buttoned up, because it kind of sets the tone. If your financials are kind of in disarray, it kind of is a signal to a buyer that maybe you're not running your business as well as you think you are. And we've come across that in multiple sort of deals and opportunities where the business looked really good from the outside in, but once you dug in, you realized it wasn't as good because they weren't properly accounting for things, or they didn't understand certain things. So definitely want to have a good accountant or a good advisor to help you with your financials to make sure they're in good working order.
And John, if I may,
Sure.
to that point, certainly the owners, as far as the largest portion of membership with the CLDA, one thing you need to consider also is normalizing those financials, because a lot of personal expenses and things are run through the business. So go ahead and start, there's nothing wrong with that. You can do it, but go ahead and start identifying some of those things so you really get a clean picture of how profitable the company is, because they will normalize it from the standpoint of pulling memberships, club memberships or whatever it might be out.
Fancy cars, stuff like that.
Yep.
So
One thing, John, I just wanted to add, just in terms of what the process looks like, right? There's the due diligence requirements, but in terms of how is the process typically staged, right? Obviously, you are thinking about selling your business, just first defining your goals, right? Am I retiring? Is it succession planning for my family? Am I looking to bring on investment, outside capital, so I could scale my business? Those are all different goals, will lead you to different buyer types. At the same time, through the process, you're going to identify different buyers. You're going to have to vet those buyers before you start sharing information. How well capitalized is the buyer? What's been their track record in the industry that I'm in, or in track record in general? How have they dealt with other sellers? Those are all important factors. Then you get comfortable with a set of buyers and you share information with them. That's kind of the pre-LOI diligence process. Some of that is, that's all typically under NDA, but it's not that level of deep dive diligence until you actually select the buyer that you are potentially going to go with. So that part of the process where you're sharing financials, you're sharing, redacted customer lists, some information is not going to be as deep dive as what are your loss runs, getting upfront of any pending litigation, obviously. And then once they have information to be able to determine what valuation they're going to offer and what structure they're going to do for the deal, then you select the buyer. You enter into an LOI, and I'm sure we'll get down to there, which has some period. And then you get into that deep dive diligence where the buyer brings in their third-party advisors, and some buyers do it internally, and head to a closing event.
So Alex, drill a little bit deeper on that, and anybody else is welcome to chime in as well. So if I'm, looking to exit, am I well served to try to go through that process on my own? Am I well served to try and find somebody outside, whether it's a lawyer or financial planner or somebody from a M&A standpoint that can help me with that diligence process? Speak to that a little bit, and then, like I say, anybody else that wants to contribute, please do.
Sure. I mean, advisors are critical. Buyers have their advisors, and you should be well represented. At the very least, you need to have the right legal counsel that is experienced in M&A, understands what, kind of terms are market, what the process should look like. You should, have other consultants, and if an investment banker or business broker, this is kind of, you feel that you need that to help market your business, I would think about an investment banker or business broker in a way where, maybe you need help finding potential buyers, right? You need help thinking through what's the market trading at, right? They could provide a lot of really good advice. And typically those types of buyers or advisors will set up some sort of auction for your business. You could also go it alone. There are plenty that do. They feel like they have a good handle. They know what the process is like. But always getting some outside advice, doing your own research, and most importantly, having a legal counsel that really understands the market terms in a purchase agreement, and we'll get to that later, and what the process should look like so you're well represented as you exit your business or reinvest or seek additional capital.
Excellent, thank you. Peter, can you speak to the documentation and all that goes into not just the purchase, not just the LOI, but anything that they would want to be aware of that they're going to have to produce? Just kind of talk through what that looks like for the audience, please.
Yeah, as a seller, the first step as you're preparing your business, we'll call it a teaser. So again, an overview of your operations, not meant to share who you are, but more about if I'm a buyer, financial or strategic, does this company fit kind of surface level of what I'm looking to accomplish with my roll-up strategy or my purchasing power? So these advisors will help you build and develop a teaser that gives a broad overview of your organizations, potentially some of your high level financials, so that it starts to attract and build a marketplace for you. So the teaser is kind of the first important document that gets you into the marketplace, if you will. Then once you're going through the process with, working with specific buyers who are interested, then that letter of intent, the LOI, that puts down an effective dates and starts to outline the process of that transaction, 60, 90, maybe 120 days, and very specific steps that both the buyer and the seller are going to be accountable for, even down to the point where if I'm signing an LOI today, they'll say on day 7, I'm going to have a first draft of a purchase agreement on day, if I'm signing the LOI today, then I've got a purchase agreement to you, at least first draft on day 7, and it gets very chronological from there. Once you go through that due diligence process then, where you're starting getting into the data room, you're interviewing key personnel, the buyer is bringing in their third parties, then a quality of earnings report would be produced. And that's really the deep dive into the financials that Sean was talking about to make sure that all the add backs and all of the representations that you're making about your business and your revenue are actually true, and they can start to build quality multiples from that. Once you're through that quality of earnings report, then the purchase agreement is really the next formal step in terms of a document that would be signed that is effectively the sale of your business. Guys, have I missed anything from a?
Well, I would certainly add to that. I mean, absolutely spot on. There's some things that you need to consider. You know, I've seen companies very shocked at the emotional connection level. You need to be thinking about that. You know, I've worked with companies that, you know, if they really think about the process and get the right advisors over a matter of a couple years, probably doubled the multiple they was getting, not to mention the revenue increase because they strategically looked at it. It gave them time to think through the emotional component of it and what their role was to be post exit. So there's a lot of things to think about, you know, and depending on what advisors, or if you want to do it yourself, that management book, management presentations to potential buyers is a critical step. So you really need to give a lot of thought and focus to it. It's not something that, you know, I would advise anybody to wake up tomorrow morning and say, oh, I want to sell my company and I'm going to put it up for sale next week. It's a process.
Yeah, to that end, Sean, have you had an experience with an owner? You know, you bought the business and he comes in the next day and he's not the owner anymore, and kind of piggyback on what Chuck said there, because it's been, in my experience, very challenging to do something for 20 or 30 years, and now all of a sudden my new normal is different, and that can be unnerving if you don't kind of prepare yourself as you go through the process, and even if you do, I think it's probably challenging. So if you had a similar experience relative to the owner kind of readjusting post-close?
Yeah, I think, you know, it's a little bit of head versus heart. The head says, I want to sell my business, but the heart doesn't really believe that. So you really have to have both aligned. You really have to want to be able to sell the business to the right buyer, both emotionally and sort of mentally prepared. We've done different types of deals. Sometimes the owner joins us, or owners. Sometimes they want to go off into the sunset. This is kind of their last hurrah. They want to go, you know, fishing. They want to go play golf, whatever it is they want to do. And so they're looking to exit completely out of the business. And so in those scenarios, we make sure that there is a key operator or operators that can then help transition into us. So those people may stay on for 6 months, they may stay for a year, they may stay for 5 years. It just really depends. We've done, like I said, 8 acquisitions, and I think we have people in the company from almost every one of them except for maybe 1 or 2. And some are in, you know, executive leadership roles, some are in middle management. Just it sort of varies depending upon sort of the goals of the owner. But we like when an owner wants to join us. It's a signal that they're not like running for the hills, and they're going to stick around to help us, you know, work through the transition. They have a lot of institutional knowledge that helps us make the transition successful. So we look for that.
Absolutely. Thanks for sharing. Alex, drill a little deeper on what Chuck was talking about relative to the diligence process. And so as an owner of a business, you know, we typically have a lifestyle that's associated with that, and it could be cars, it could be all sorts of things that are tied to the business. And once you exit the business, you're going to get credit for, you know, any of those as add backs. Talk about the recast opportunity there, and you know how a potential seller should view some of those perks that they get as an owner, if you would, please.
Sure. You know, in most cases, you're going to be valued on the profitability or the cash flow that's generated in the business. If there are, and in many cases in these founder-owned or family-owned businesses, there might be relatives receiving salary that may not be working in the business. There might be, you know, Personal expenses that are flowing through the business, that's perfectly normal. We see that all the time. So it's really critical that you keep track of those very diligently, especially as you think, I mean, you should do that anyway, but also as you think about preparing for sale, because you're going to want to adjust your earnings for that, because you're going to be valued on those earnings, so you would be increasing those earnings by adjusting out. The way we typically guide sellers in that is any type of expenses that are personal, not in the ordinary course of business, any one-time, non-recurring expenses. Let's say you had to settle a legal claim for misclassification, you had to, that incurred legal fees associated with that. That would be something typically that's kind of one-time, non-recurring. Any type of potential capital investment that you made that has been expensed through the business, you'd want to kind of point that out. Maybe you made a heavy investment in technology that wasn't accounted for as a capital investment, for example, which would be, although it's a use of cash, it's not something that flows through the income statement. And there's a lot of other flavors of what these non-recurring personal expenses would entail. So make sure you outline that, identify them by month, tie them to GL codes in your income statement. That way, when the Q of E team comes in there, they're able to clearly identify what they are and back those out of your financials to give you, a true picture. And also recognize that those expenses will not continue on post-closing. Another area I would think about clearly, and this is something you should have a discussion on early on in the process. Typically, owners are, making salaries and in sometimes cases above market salaries than what their go-forward compensation is, or maybe below market salaries of what their go-forward compensation is. And you're going to want to adjust for that based on what you expect that to be going forward, whether that would be an increase to your EBITDA or earnings or a decrease to your EBITDA and earnings.
Excellent, thank you. So that's a pretty good segue into, when somebody walks up to me and says, "Hey, I want to buy your house or buy your business," my mind immediately goes to, well, geez, how much am I going to get? And everybody thinks their baby's the most beautiful, and so at the end of the day, I know the question on everybody's mind out here is, how much am I going to get for my business? And I'd like to approach it from this way, guys. So everybody's wanting a multiple that they're going to get for their business, and that to me is a lagging indicator. The leading is, how do I prepare my business to be properly valued? And as you guys value businesses, help the audience understand what they can do to advantage themselves to get the highest multiple that they can. Let's start with Chuck.
All right, well, we've hit on a lot of those components. I mean, really just understanding the process, what's involved, identifying what you want post-exit personally, so you make sure your company is positioned properly to achieve that objective. I also want to, kind of caution everybody, think about post-exit your own personal needs, because things change. Today, we talked about normalizing the financials within the business, which is a positive. It should increase the profits of the organization. Well, you're also going to lose some tax benefits and different things that you're taking advantage of because you have the business. So when you think about what you need post-sale, and when you think about what your lifestyle and what your needs are, et cetera, you really have to give it a lot of thought. And getting the right people around you, building your team, advisors that you can trust. The tax implications can be huge, both on the selling the business side and post the sale on a personal side. So really think through the process. Start now, because if you're running your business like you're going to sell it tomorrow, your business is going to be stronger and better no matter what you do. But start today, run your business that way, think about what you want, and get the right people around you so you can maximize that.
Absolutely. Peter, any additional thoughts around that?
Well, I was going to add from a due diligence standpoint, I mean, what the buyer is bringing in is a very effective, highly trained team that is going to look at everything underneath your business. And so there's no hiding, and just accepting that on the front end and doing everything in the, the previous 12, 24, 36 months to prepare for that, to be fully transparent and fix what you can and control what you can to get best positioned for sale. I mean, due diligence is, it can be, 30, 60 days, guys, when we're talking average timelines?
It depends.
aggressive.
I mean, it depends, but.
Depends on
in
what-
today's market, but.
I think it all varies in terms of the timeline of a post-LOI process, which includes due diligence and purchase agreement and other ancillary agreements. Depending on how long the buyer takes, sometimes it takes a lot of time for a seller to produce information. I think the most important thing is you find a partner that's willing to work with you on your timeline. You still have to run your business day to day. And the worst thing that you could possibly do is take your eye off the ball on your business and your earnings start to dip, because that will create questions.
Alex,
Yeah.
drill a little bit deeper on that relative to, so what is going to be the time commitment and constraints on my staff? They already have a full-time job, and so what should these guys take into consideration relative to the additional burden of producing the diligence and going through that process?
Yeah, I think you need to come into it eyes wide open. It will be a strain, especially on whoever is your controller or your CFO exceptionally. Consider ways to keep that person motivated, whether that be a sale bonus or any type of, opportunity post-close. If you're doing it yourself, it's going to be a heavy burden, and make sure that there are key operators in place to take over your role while you're focused on the process. I would say the biggest time commitment in the process is going to be the financial accounting, the accounting due diligence. You'll have advisors. I mean, your legal counsel should be able to assist and help you greatly on the purchase agreement and legal diligence aspects of the deal. But you're going to have to be producing a lot of information, answering a lot of questions, making yourself available. People will dig into things as granular as, well, why did margin go up this month versus that month? Why is this customer's margin this way versus that way? And it takes time to answer those questions. So just go into it eyes wide open with the full expectation that it is going to be a time sink, and it's going to be a distraction from the business, and be prepared to make sure that business continues to operate it the way it would without this process in place.
Sure.
Yeah, so, all the more reason to start preparing today, because I can tell you, I've worked with companies that did not give it forethought, did not start preparing, and the burden on your staff and on the organization, if you're starting from scratch and trying to hit timelines, is overwhelming. Another thing to consider, to some of the points that Peter brought up, was a lot of sales. I mean, a sale can be your best friend too. You can sell X% of your business or all of your business and get a private equity or a strategic partner of some sort that brings resources to the table, and you can have a second payday as part of the deal. So a lot of owners will take money off the table, stay engaged with a second payday, but now you've got resources that you didn't have before, so you can expand the company, grow the company faster, and in a certain time span, realize even a second payday. So-
Absolutely. Sean, piggyback on what Chuck's saying there relative to, actually what Alex was speaking to. So that's a potential upside. Talk about anything that you might have experienced relative to the purchasers or sellers' staff, because there's a bit of confidentiality. You don't want to scare anybody unnecessarily, and truly until you go to close, it's not a done deal. So how do you go about, or what have you experienced in folks kind of managing that? keeping it close to the vest until it was appropriate, and then the messaging that goes along with, well, why are we doing this, and how does this impact me?
Yeah, so we've had a couple of different situations where the owner didn't tell anybody, and so that made things a little difficult through the process because it makes it difficult from a due diligence standpoint. And it's also kind of one source of information, so maybe not everything's exactly as they think it is. To the opposite, where they told the whole company, you know, after signing an LOI, and the deal didn't get done. And so now you have a bunch of employees asking, you know, why didn't this deal get done? What happened? Sometimes people are already thinking about the bonus they're going to get. You know, maybe they've already spent the bonus before they even got it. So you just got to be really careful within sort of the inner circle who knows what's happening, and that you can trust those folks. They're adults, because these things take lots of twists and turns. They just do, and you can get literally to the 1 yard line and the deal falls apart. So you just want to be mindful of that and be careful and make sure the people that you bring into this inner circle of trust, you know, you can rely on them. I'd say the other thing is, you know, when dealing with the buyer, right, you're going to want to produce a lot of the documents that we've talked about. You're going to want them in obviously very clean, easy to read order. We talked about a data room early on. I've seen data rooms where it's just a trash can of files and folders. You want it organized. It sounds silly, but like organize the heck out of it, right? Have everything correctly labeled and marked. That kind of stuff goes a long way, makes the process go faster. We've seen lots of due diligence periods drag on because stuff just isn't in order or stuff isn't where people thought it was, and so we spend weeks looking for stuff. So.
Absolutely. Excellent information. So we're going to shift gears, guys, and throw it to the audience for a little bit. I want to give you guys a chance to ask some questions relative to, you know, what you might do or need to do. So Harold first, and then this gentleman second. Harold?
I had two questions. One is a quick
Hey, hang on, Harold. We got a speaker coming your way.
Can you hear me now?
Yes, sir.
I had two questions, one for Alex. You talked about an investment banker or a broker. Do they get a commission or a piece of the action? Is it like a real estate transaction where they split the commission in half? How does that part work?
That's, it is very similar to a real estate broker. They do get a commission. You'll have to negotiate that with your banker. But that typically is paid by the seller and not the buyer in that case.
Okay, and my next question is, I think you have all size companies in the room, probably. It might be beneficial for all of us if you could give a little insight when you use the term multiple. Like on a smaller company, my understanding, smaller revenue, the multiple might be smaller, but a larger revenue company, the multiple might be larger. If you could maybe share or shed a little bit of light on that aspect of this process.
Sure, happy to do so. I'll take a step back in terms of how companies are typically, or how we value companies. You know, everybody values things differently. Ultimately, the value of your company is what somebody's willing to pay for it. The way we think about valuation of businesses is, you know, as somebody who comes from the finance side of things, we are looking for a specific return on that investment over a period of time. So how is what cash flows is that business going to generate over, let's say, a 5-year period, what that terminal value is. We back into, you know, what our cost of capital is. Different companies, buyers have different costs of capital. So it's a little bit, so you kind of get to a number that way. And then you take a look at really what else determines the value of business. Well, what have other people paid for similar type businesses? So that could be triangulated in a couple different ways. How are publicly traded companies in the logistics sector trading? How much have they bought? If they bought last mile companies, what did they pay for them? That's typically out there. Take a discount to that for size. And then precedent transactions, other privately held transactions between privately held companies or private equity firms. Sometimes you could get that information. A broker or an investment banker may have some of that insight. Typically, those types of multiples are confidential, but buyers that are in the space consistently have some idea of what that is. So you take those factors, you triangulate. So where do we get to in terms of multiple? And you mentioned size. So, the way we think about multiple is companies with larger levels of profit typically get higher multiples than those. So there'll be a range of multiples for companies that are sub $1 million of EBITDA. There'll be a range of multiples that are 1 to 3, 3 to 5, 5 to 7, above that, right? And typically the higher your earnings, the higher multiple you're going to receive. Other factors that go into determining customer concentration. Buyers look at not only the opportunity, but the risk. So if 50% of your business is with one customer, then that may have an impact on what a buyer is willing to value because they're looking at kind of a risk-reward scenario. They're trying to mitigate that risk. Maybe they put some structure around the deal. And everybody's business is different. Not saying go out there and go diversify your customer base, right? Sometimes it's not feasible to do that. So just recognize what you have and what that impact could have on your valuation. Your historical growth rate, right? If you're a company that is been kind of flat for the last 5 years, right, you may have a different valuation multiple than one that's growing 20% year over year every year, right? Because it's likely that you're going to continue down that path, and those cash flows over time will increase for the buyer. So those are some of the factors. There's some non-financial factors, like how good is your IC compliance? Is that in good order, right? That could be just take buyers completely out of even considering the business. How strong is the leadership team? Is the buyer going to have to really invest in technology to achieve the growth that they want? So they may factor that in. Are they going to have to add executive leadership? If you're going to be the platform and you've kind of been wearing all the hats, well, in order for me to get that additional growth that my investment thesis or plan is behind, I'm going to need to add, maybe a chief commercial officer, a COO, a CCO. So that's going to be additional expense on the business. So there's a lot of different factors, and I've tried to if I missed anything, anybody else here on the panel, please feel free to jump in. But that's how I think about it.
That was great info, Alex. Lorena?
Can you speak a little bit about how you evaluate our customer list? And specifically, a lot of us do work with 3PLs. So do you guys consider that, or do private equity firms consider that as sustainable revenue?
So, Sean?
Yeah, I think for us, right, the customer list is, customer concentration, as Alex mentioned, is important to understand. Are the customers heavy in one segment, right? Is that a segment that we're interested in, or is that a segment we're not interested in? So that's something we're going to look at. Typically, these businesses, the top 10, 15% of the customers make up the lion's share of the revenue. So we do expect to see a few big customers. From the standpoint of sort of how do we value those customers, I think that do those customers have the opportunity to expand, right? Can they grow, and are they growing, right? Your business may not be growing a whole lot, but if you've got one customer that has been growing over the last several years pretty steadily, and can they continue to grow? So those are things that we're looking for.
Well,
Yeah,
and Sean, how about speak to a little bit, a lot of customers have a clause where if you sell, they have a right to go another path.
Yeah.
And so you're going to want to.
I think everybody in this industry knows that the customer contracts are not worth more than the paper that they're written on, right? Everybody can leave you or leave me with, roughly 30 days notice or even a week's notice in a lot of cases if the services aren't being rendered in the way they expected. So that's part of the challenge of this industry is you're not buying SaaS contracts, you're buying, commercial service contracts. So just be mindful of that. People are going to, some businesses are going to look at that differently than others. I think it just depends on who the buyer is.
But
Yeah,
Peter,
know your employee or your customer contracts well, because many of them will even state that if you're in the process of selling, once it gets to a certain level, they have to be notified, which triggers potentially a number of different activities. as well as the due diligence. The buyer will probably want to go and meet with the top accounts face-to-face, understand the relationship, make sure that it's stable moving forward, et cetera. So understanding those agreements are important.
I just want to answer.
Sure, absolutely, Alex.
You know, when we look at customers, and Sean made a great point, what are the end market verticals those customers are in? Is it life sciences, or are you moving documents, right? That will be valued differently. What's the gross profit margins of those customers? What are those customer types? Are they a 3PL or a direct shipper? And ultimately, to get somebody comfortable, right, you know, in many cases, direct shippers are preferred because 3PLs have a lot of options for service providers. That's what they do. That said, you know, if you have, you know, customer stickiness and sustainability of revenue and margins and lack of volatility in those revenue and margins is going to be a key consideration. You know, having 3PL customer base is not a deal killer. It provides density, volume, base load, right? We understand these things, and there's value to having those, keeping your drivers engaged. So I don't think it's a deal killer, but I think, you know, from our view, you know, our preference is for direct shipper customers because we think those relationships are a little bit stickier. They're more reliant on you. But it's at the same time, you know, just trying to solve for that appropriate mix as you think about maximizing the value of your business, even if you're not even going to sell it, right? You know, internally, it's something that you should think about carefully.
And think of your product mix now. If you are trying to be everything to everybody, sometimes that, you know, is a concern. You know, if you specialize in healthcare and you're the top performer in your geographic area, that's going to help. You know, be it healthcare, be it e-commerce, be it big and bulky, whatever it is, you know, specialize in, you know, be the best in your geographic territory, and, you know, the rest of it will take care of itself.
Absolutely. So we've got time for one more question, this gentleman.
Thank you. From the normalizing perspective, you need to identify, you know, specific expenses and maybe some revenues as well that are not part of the business, but they're also not recurring, right? In this case, how do you see the pandemic itself? I mean, it's hopefully not going to repeat itself, right? So we had a lot of additional expenses and even some revenues. You know, there's a lot of people here that were moving, you know, COVID tests around, and that's stuff that's going to come around. So how do you, as a buyer, look at the pandemic?
Yeah, we've made several acquisitions, you know, looking, and with the most recent financial period being in the 2020 period, right? And that's why it's important to have a historical view of the financials and really understand, you know, on a pro forma normalized basis without a black swan event happening, you know, what the earnings of the business are. And, you know, if there's disagreement about that, you could try to bridge that gap through structure or other means. To your point, there is revenue, right? PPP revenue. People have gotten that. That's going to be adjusted out. But similarly, you know, a lot of companies, you know, right in the, you know, second quarter of 2020, even third quarter, may have dipped 30%. Am I going to value your business based on, you know, this type of event? No. I'm going to take a look. What did you do in 2019? What did you do in 2018? What are you doing in 2021 and 2022? And I'm going to think through that and triangulate what, and work with you and talk to you and be transparent with you about how I'm thinking about your kind of normalized revenue and earnings. And just having that communication and transparency is really important with.
And I think, real quick to add to that, different buyers are going to approach that differently as well. And so you'll see that in the deal structure, where some will be more cash heavy on the front end. We're talking about roll forward equity and earnouts. So they'll value that differently, and they'll incent you different ways based on what they think is going to happen in the freight market. I mean, the reality is there's record kind of transactional multiples happening right now against record earnings, especially in last mile, final mile. And so they paint that picture on what they think the forecast is going to be on a go-forward basis, and then there'll be different options available to you based on that.
And also think about your story behind that. So, for example, PPE equipment, you know, whatever it is, you know, how flexible, how adaptable, you know, is your organization? How strong are you to take advantage of those types of opportunities? So tell your story to help balance any of that out.
Absolutely. Oh, guys, a couple housekeeping items before we wind down here. You heard in the last segment the ask on the advocacy fund. I'm a prior GAC chairman and very near and dear to my heart. Harold Boyette shared with me prior to us coming on stage that he's an ex-UPS guy and he still has contacts over there, and their folks every year under mandate give half of 1 month's pay towards their advocacy efforts. We're certainly not asking for that. $5, $10, $20. The fact that you're giving means that you're engaged and you understand the value. I will echo what was asked before. Please consider joining our efforts and also contributing, because it really, really makes a difference. In California, AB 5 was going to be heard by the Supreme Court. They declined to hear the case, which means it goes back to the Ninth Circuit, which is not good for anybody in transportation in California. And, it could be in a theater near you sooner rather than later. So appreciate everybody's consideration there. I've got a closeout question because I know it's on everybody's mind, guys. It's the elephant in the room. What are you guys seeing in the way of multiples right now, since we've given the proper perspective that all deals are different, but give the audience an idea of, your sense of the range that they could probably expect. Sean?
Really put me on the spot here. I'd say if it's a sub $10 million business, top line, that's got decent margins, kind of the 8 to 12% range, you're looking at somewhere between 3 and 5 times EBITDA. And that can vary based on, is it growing, is it not growing, is there one customer that makes up 75% of the business? There's a variety of factors like we discussed today. But that's kind of the range that we've seen over the last couple of years. Yeah, I think things have gotten a little inflated maybe in the last 12 months. I don't know if that's sustainable or not. These businesses are precarious businesses to buy because the sort of customers can leave after a transaction. So they're always going to somewhat be de-risked by the buyer.
Okay, thank you. Anybody seeing anything different? Alex?
No, I would agree on kind of the sub $1 million, to $1 million EBITDA, or even 1.5, that 4 to 5x on EBITDA range is pretty market, and it all has factors based on end market verticals and the things that we previously mentioned. On the top end, right, if you are, in that $5 to $10 million of EBITDA range, we're seeing anywhere in the 7 to 10x multiple, depending on a lot of the factors that we've discussed in this room.
Thank you. Chuck?
Yeah, John, I would say, that's probably the first question most people ask. Don't focus on that. Think about what the landscape is, what the future environment, it's been there's been a lot of money available for quite some time now. Looks like that'll probably tighten up. Think about future tax implications on the land, on the horizon. That's going to change some. But more than anything, look at your business today. What can you do to improve that so a strategic buyer is looking at you and driving the multiples up? So, we can sit here and speculate what the multiple would be, but there's so much work that goes in behind that if you're setting your minds on a X number, boy, that's a real shot in the dark without actually sitting down and getting into it.
Absolutely. Peter?
Yeah, I was going to agree with Chuck. I mean, the simple way to put it is care less about the multiple, but think more about the multiple of what. And so as you're going through that planning stage, 2, 3, 4, 5 years, what you can control, what you can reinvest in, what you can acquire, how you develop your people, I mean, even on, it's less important in this room, but on the asset side of things, truckload, real estate, I mean, we're seeing crazy deals and multiples there just because the asset values are the way they are right now. But you can't predict, you know, used trucks going for $200,000 a pop and people being able to borrow against those. So focusing on what you can control.
Absolutely. Guys, this is a very meaty subject matter, and there's lots of moving parts to it, and I encourage what was said earlier. Find some good advocates all the way around the horn. These guys have a ton of experience. They're willing to talk to you post the panel discussion here. At the end of the table, there is just some considerations that we felt like if you're going to go down that path that you'd want to consider. So please take those and hopefully find some value in them. I'd like to thank all of our panelists. Very, very engaging conversation. I hope the audience found value. Thank you very much for everybody's attendance.